Inflation is the buzzword right now in almost every conversation, from the farmer to the Wall Street executive. And while most people are, let's be honest, somewhat worried about inflation because we don't know what the rest of the year holds or the future going into 2023, some people are cautious about putting their money into the stock market or investing more money into the stock market. But there is one sector or industry that is having very good returns right now and has a very, very positive future going into 2022 further and into 2023, and that is REITs, or real estate investment trust. Just to give you an idea of the percentages or the growth we're talking about. In 2021, the S&P 500 rose roughly around 27%. During that same time period, REITs, or real estate investment trust, rose over 47%. So as we progress into 2022, real estate investing is somewhat still a top choice for investors because of the uncertainty of the stock market. Typically REITs, if I hope I'm pronouncing that correctly, tend to have a higher yield, solid growth, very strong fundamentals, and a brighter outlook when you look at consistent improvement over 5 to 15-year windows. And some people look at this as more of an inflation hedge during times like we're going through right now. So for today's video, I'm going to cover 3 main particular REITs and really talk about the strong fundamentals, what is driving the growth, and why to have such a positive outlook moving forward as we progress in 2022 and for the next 5 to 15 years. Now, before we get started, I do have to throw out an apology for Adam and myself. We haven't pushed out much material the past couple of weeks simply because we both had different jobs and it's been very hectic for both of us. As you can see, my background is a little different than the previous videos. It's because I'm currently traveling with work the past couple of weeks, so I'm finally been able to sit down, put a video together, and push it out for you all. So the first REIT we're going to talk about is Essential Properties Trust, or ticker symbol EPRT. EPRT is currently trading around $25 a share with a 5-year growth of over 86%, including, as you can see with this arrow, that massive drop back with COVID in 2020. But what exactly is this company? Well, Essential Property Trust is a real estate company that engages in the ownership, acquisition, and management of single-tenant properties. If you're new to this concept of REITs, think of it as a commercial landlord. Landlords own homes, they rent them out to tenants, and that's how they make their money. It's the same way in the commercial industry. Warehouses, malls, strip malls, restaurants, movie theaters, the list goes on and on. There is a main company that owns hundreds, if not thousands of properties, and they lease it out to tenants. And in terms of talking particular about Essential Property Trust, some of their tenants are very well known throughout the United States. We're talking about McDonald's, we're talking about A&C movie theaters, Circle K gas stations, and even Marriott hotels. But here's what I like to talk about, and that is financials. EPRT ended the fourth quarter in 2021 with over $322 million and almost $1 billion for 2021 overall. They also earned an A grade in almost every growth section by the analysts on Seeking Alpha. In addition, they recently increased their dividend payout that now sits at over 4% with an annual payout of roughly $1 per share. Now the second one we're talking about is WPC Carey Incorporated, or ticker symbol WPC. WPC is currently trading around $85 a share with an increase of slightly more than 30% over the past 5 years, which is noticeably less compared to EPRT, which was almost 50% more. Now WPC really has a very diverse commercial portfolio, and they create an annual income of over $1.2 billion per year, and they boast an occupancy rate of over 98%. And then if you look at this photo, you can see that some of their largest tenants include major companies such as U-Haul, Marriott, and Advanced Auto Parts within the United States. One thing I do like about this company is how diversified they are, not as far as their tenants, but where they are located in order to maximize the amount of revenue they can bring into the company. When you look at this pie chart, it simply showcases itself. They are across the world. And this can bode well for a company because you're able to weather some economic downturns if they are country or continent related. Now, obviously, if it's something that affects the global economic economy, they are going to experience those downturns. But if it's something where if it's experienced downturn in the United States, but Europe is doing very well, they're able to weather some of that so it doesn't hit the company as hard, which in return benefits you and I as investors. And then the third or last one we're to talk about is Life Storage Incorporated, or ticker symbol LSI. LSI is trading around $144 a share right now, but has an impressive and consistent growth of over 155% the past 5 years. Now, I don't know about you, but I tend to nerd out or get a little giddy when I see a chart that looks as good as this one does. Within Life Storage services to its consumers, they offer commercial, vehicle, residential, and even wine storage for its customers across the United States and Canada with over 1,000 locations. The truth is, I travel all over the United States with my job. And if there's one thing that is consistent from the East Coast to the West Coast, that is self-storage units. They seem to be popping up everywhere, whether it's Life Storage, you have Public Storage, you have CubeSmart, the list goes on and on. And that's just the major ones. You have all these small mom and pop ones that are popping up, in the corners where they may be 100 or 200 units. So one thing it has a common trend across the United States is people are utilizing self-storage more and more now than ever before. But just don't take my word for it. According to their website, LSI has seen almost triple digits growth between 2015 through 2021. Compared to other commercial real estate companies such as fast food industry or malls, etc., self-storage units very commonly have very low expense rates, which typically bodes well because they're not spending out thousands or millions of dollars each year on expenses because they don't have the overhead costs like a McDonald's does. And then we look at LSI's dividend, which is what almost every stock I own in my portfolio pays out a dividend because I like that passive money each month or each quarter. LSI currently pays out a dividend yield of 2%, which comes to about $1 per share, which is paid out each quarter. I do like their low dividend yield because there is room for growth. As we've seen with the other REITs, they increase their dividend. So 2%, anywhere from 2 to 4%, I'm comfortable with. That means they're not paying out too much. And there is, like I said a minute ago, there's room for growth within that dividend yield payout. The truth is, these are not the 3 stocks or 3 REITs that you should invest in. There are many other companies out there that have very good returns. I personally invest in several other ones. This is just kind of give you a highlight of, if you're not investing in there, it's something to pique your interest. But as always, investing is always risky and there's always an inherent unknown to it. So please do your own research. Reach out to a certified financial advisor or consultant to determine if investing in REITs or real estate best fits your portfolio, because at the end of the day, you want your money to work the best for you in lines with your future or your goals. As always, guys, thanks for watching. Thank you for supporting the channel. If you haven't already done so already, please hit that like and or subscribe button. It really helps the channel out, lets us know we're pushing out great content. And post up in the comment section if you have any advice for myself or any other investor within the real estate market.